Hey everyone, and welcome. So today we're getting into something absolutely crucial, architecting a stress-free investment portfolio using systematic allocation strategies. Whether you are opening your very first brokerage account or you've been, dabbling for a few months and maybe feeling a bit overwhelmed, this explainer is built specifically to give you absolute clarity and a rock-solid foundation. Let's just dive right in. Now, what's kind of wild about this question is the assumption we all tend to make. Like when we hear about beginners losing money or just throwing in the towel, we automatically assume, oh, they must have picked a terrible stock or a really bad ETF. But you know what? The data tells a completely different story. Beginners usually don't fail because they pick bad funds.
The real issue? They just don't have a system. Completely lack one. Instead of having the structured game plan, they end up treating their hard-earned money like, a random collection of trendy ideas. They'll buy whatever ETF popped up in their feed yesterday, or chase a stock that's trending on social media today. They're constantly reacting to the market instead of actually directing their money.
Section 1. The Beginner Investing Track.
So let's look at this trap, because it is incredibly easy to fall into when you first start out. It's a super common story. Honestly, if this sounds like you, you are definitely not alone. It's called strategy drift, and man, it happens fast. You start out super strong in month 1. Maybe you responsibly drop a lump sum into a broad fund like SPY. Awesome, so far so good. But then month 2 rolls around. Everyone's talking about tech, so you grab an AI ETF because, hey, AI is the future, right? Then by month 3, you read about passive income, so you pivot and chase a dividend ETF. Fast forward to year 1, and what do you actually have? You don't have a strategy anymore. You just have this chaotic patchwork of different ideas. And investing without a clear allocation strategy leaves you in a really tough spot. You usually end up with a bunch of overlapping funds that are literally just packaging the exact same companies in different wrappers. But more dangerously, your overall risk level becomes completely a mystery. You have absolutely no idea how exposed you are to a market downturn because, there's no consistent strategy guiding those decisions.
Which brings us to Section 2, Your Money Blueprint.
So this begs a pretty big question. If a random, reactive collection of ETFs isn't a true portfolio, what exactly is it? I absolutely love this definition because it completely shifts how we think. A portfolio isn't just an inventory of what you own. It's your money blueprint. It is the master rulebook that decides ahead of time exactly how much of your wealth goes into growth, how much stays in stability, and how much risk you're actually taking. Think of it like a customized marathon training plan. You wouldn't just go out and do random sprints every day and expect to cross the finish line of a marathon, right? You need a structured plan built for endurance.
And there is a vital difference between these two mindsets. Changing strategies every single month based on the crazy news cycle? Total trap. The real path to wealth is picking a consistent plan that you can actually stick to. Seriously, the best investing style isn't the flashiest one, and it for sure isn't the most complex one. The absolute best portfolio is the one you can stick to without second-guessing yourself every single time the market takes a dip.
All right, Section 3. 3 Proven Portfolio Strategies.
Let's get into the solutions and look at 3 distinct, totally proven blueprints. And look, the goal here isn't to declare that one is universally better than the others. It's about finding the perfect match for your unique personality and lifestyle. So our first option is the beautifully simple set and forget portfolio. It is incredibly straightforward. You put the vast majority of your money, we're talking 90 to 95%, into one broad market ETF, like a total market or S&P 500 fund. That remaining 5 to 10%, that just sits in cash or money market fund. With this blueprint, you are basically betting on overall economic growth, rather than trying to handpick individual trends. If you want long-term growth without the stress, this straightforward lane is absolutely for you. There's no overthinking here and definitely no monthly switching. It is highly recommended for busy professionals, brand new investors, or, quite frankly, anyone who doesn't want investing to become their new part-time hobby. It's minimal maintenance, but delivers seriously powerful long-term results. Now, if you're someone who likes a bit more balance and structure, let's check out the 3-bucket portfolio. Here, your money is split into clear, highly defined roles. You've got 30% in a broad market ETF for stability. Then another 30% goes into a growth ETF for that aggressive, higher upside. Another 30% is allocated to a dividend ETF for income and extra stability, and then the whole thing is rounded out with a small cash buffer.
This strategy is brilliant because every single bucket has a very specific job to do. One grows steadily, one pushes for aggressive growth, and one generates reliable income. Because of this setup, dips in one area of the market are usually balanced out by the others. It's a perfect match for investors who get a little nervous about all-in strategies and really prefer the psychological safety net of different assets balancing each other out. It gives you real diversification without the overwhelming complexity.
Then, for the advanced beginner who wants to be slightly more hands-on, we have the core and satellite portfolio. A massive 70% stays right in reliable core ETFs. Those are going to do the heavy lifting for your wealth building. But then you carve out this 20% satellite slice for individual stocks, maybe some thematic plays, or even advanced strategies like options, leaving 10% in your cash reserves.
If you're a confident beginner who still wants the thrill of picking a few individual stocks or exploring some exciting new themes, this blueprint gives you that control. You basically get to scratch that active investing itch with your satellite funds, but you do it safely. You aren't risking your entire financial foundation because your core is still just steadily building long-term wealth in the background. Moving right along to Section 4, Diversification vs. Duplication.
Okay, before you officially pick one of these strategies, we absolutely have to talk about a massive pitfall that traps almost every single new investor. It's this fundamental misunderstanding of a huge financial buzzword. Beginners often think diversification simply means buy more ETFs, like quantity automatically equals safety. But real diversification means buying different exposures with a clear purpose. Buying 10 different ETFs that all heavily feature the exact same US tech giants, that is not diversifying your risk. It's literally just duplicating it. You really have to know what is actually inside the funds you're buying.
And finally, Section 5, the real secret to wealth. Let's pull all of this together. We've looked at the traps, the blueprints, the pitfalls, and you might be sitting there stressing right now about which of the three strategies is the absolute best. But here is the truth that most people ignore. You do not need a flawless, highly complex portfolio to win. What actually matters far more than the specific strategy you choose is consistency, a clear structure, and long-term discipline. A simple, basic strategy that you execute with relentless discipline year after year will always, and I mean always, beat a complicated portfolio that you constantly shift around based on your emotions.
It really all comes down to this simple truth. We spend so much energy trying to guess what the market is going to do next month or next year. But real investing success is about eliminating those emotional decisions. It's about setting up a blueprint that allows you to simply stay invested long enough to give the mathematical magic of compounding the time it needs to truly work for you.
So I'm going to leave you with this final thought to ask yourself the very next time you log into your brokerage account. Are you looking at a clear, intentional money blueprint? Or are you just staring at a random collection of trendy ideas? Take the time to architect your system, stick to it, and let time do the heavy lifting for you. Until next time, keep learning and happy investing.